Hey option traders, for today's trade we are looking at an option play in Dow Jones stock Boeing. So looking at BA on MarketSmith, we can see that it's moved up to resistance around its 200-day line, but has failed to reclaim this price area. Shares are also beginning to fade back below the 21-day moving average as of yesterday, and this is a bearish indicator and suggests that the stock may not have sufficient institutional support to hold above that area at this time. The Aerospace and Defense Industry Group currently ranks number 99 out of IBD's 197 industry groups, which is okay, but it's not super strong. Furthermore, the company estimates losses for the 2022 year of $1.36 a share. Once again, a 69 relative strength rating shows mediocre price performance and that the stock is not a major outperformer currently. So with all of that said, we are looking at a trade here that will benefit if the stock moves sideways in stable fashion or moves slowly lower and finishes around our specified strike price upon the option expiration. A put ratio spread is a multi-leg neutral strategy with undefined risk and limited profit potential. This is not a trade strategy for beginners, so if you're new to this, please try it in a virtual account first to sort of get comfortable with it. It's generally considered a neutral strategy, although it can technically make money no matter which way the market goes. So the key here with this trade is timing. The strategy looks to take advantage of a drop in the underlying volatility in the stock, time decay of the option contract, and a move a little lower from the underlying. Time decay is simply the loss in value in an option contract that occurs as it gets closer to expiration. Put ratio spreads have three components or legs of the trade. Remember that with options there are two types. You have calls and you have puts. With both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy it long or sell it short. To set up a put ratio spread, for the first leg, you'd need to buy one in the money put. For the second and third leg, you'd need to sell two out of the money puts at a lower strike. The short puts will have the same strike price. All three put options will have the same expiration date. So the difference between an out-of-the-money put and an in-the-money put are very important here. The higher strike long put is considered in the money because if I own that put, it would allow me to sell the stock instantly at a higher price than it trades at currently. This instant profit potential means that the put is in the money. The lower strike puts are out of the money because the option has no profit embedded into it at the time of initiating the trade. Put ratio spreads may be opened for a debit or a credit depending on the pricing of the options. A debit means that you'd pay money to establish the trade, and a credit means that you'd receive a premium for establishing the trade. Put ratio spreads are typically established for a credit. To reach the maximum profit potential of this trade, the underlying stock would need to decline in price and close at or near the short strike prices upon the expiration date. If the put ratio spread is initiated for a credit, the profit potential is the amount of the credit received plus the width of the spread between the long and the short puts. However, if the underlying stock price rises above the long put leg of the spread, a profit will still be realized. All of the legs of this option trade would just simply expire worthless, and the initial credit received would remain in your account. Put ratio spreads have undefined risk if the stock price experiences a significant move lower, undercutting the short put strikes. A put ratio spread is used when the underlying stock is at least expected to stay within the range between the two strike prices before expiration. So now that you have a better idea of the mechanics of the put ratio spread, let's take a look at my trading platform and set up a real-life trade using Boeing. So using BA as the ticker symbol for this trade, looking at Boeing, Make sure that you're in the October 21st expiration date. Also, if you're on Thinkorswim, you want to select back ratio as your spread type here. And then looking down at our list of strike prices, we're looking for the 130, 140 pair, but they don't have that here. So we will just select this one here and adjust down below. And this is the side of the screen for put options. And to sum it up, we are looking to buy one October 21st expiring 140 put and sell two October 21st expiring 130 puts. So we'll switch that here. 130 puts. And the total credit that we're going to receive for this is around 27 cents in total premium. So investors could look to buy an October 21st expiring put with a strike price of 140 and look to sell two puts with a strike of 130. The trade results in a net credit of 25 cents in total premium received. This is the maximum gain above a stock price of 140. Basically, all the puts would expire worthless and you'd simply keep the $25 premium. A tent-shaped profit zone exists between 120 and 140, with the maximum gain occurring at around 130 of around $1,000. A put ratio spread is not a great strategy to start with for beginners. It's definitely best to practice in a virtual trading account before risking any real capital. So only try this trade with real money if you have a really good handle on the risks of the strategy. Always remember that options are very risky and complex. Investors can lose 100% or more of their investment. And be sure to check out investors.com/options for more option trading tips, and we'll see you here next week.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.